Let Michelle in.
Yep, let her in.
Oh,
Let her...
Amanda's here.
Oh.
I admit them all.
Okay. I let the wrong one. Okay, here we go. Good morning.
Good morning, everybody.
Good morning.
Good morning. Good morning. Thank you
Morning.
so much for your patience. Oh, there's her beautiful face. Thank you
Good
so much.
morning.
We have Michelle here, guys. Sorry, we just had some technical difficulties, but welcome, welcome. We're so excited. David, pleasure as always. Good to see you guys. Good to see you. So, first and foremost, always, it's such a pleasure. This is our last one of the year, and so I'm so excited to have Michelle on. If you guys don't know, I'm sure everyone is very familiar because we're seeing some faces. We're like, yes, Michelle is bringing her following. So thank you for blessing us with your presence, and then everyone can join us because just a wealth of knowledge, and we're appreciative.
I see some friendly faces. So thank you so much for getting up. If you're like me I got a tornado warning, which was the first in my history in San Francisco this morning. Power's down, so sorry about the dark shadows hitting here, but hopefully it'll lighten up a little bit. Just got in from Dallas last night after spending a week doing due diligence, and I'm so thrilled to be part of this group. I'm extremely excited to share some knowledge. I see some friendly faces, Dave, Tyler, of course, Winston, and of course, Kimberly. I see Amanda and Hitomi. Jerry, hello. So I'm Michelle. I think I've met you before. Awesome. Thank you so much, all of you. So I'll make it worth it, besides pouring coffee.
I do want to ask real quick, I saw something about some hawk, like you guys had the arm out and the hawk was flying in.
Oh, yes, that was yesterday. We I got to hold and feed some hawks, and then we went to a speakeasy. My team knows how to have fun, so it was a lot of, oh, there you go. Adam's on it. He could attest.
Hey, Michelle. What's up, everybody?
Hey,
About
we're
the
learning
Airbnb?
about hawks. What did you guys feed them or just hold them or?
No, the trainer fed them, but we were able to hold them, and it was kind of scary whenever he would fly off, right? Like, yeah, it was crazy.
You have to wear like super thick gloves?
Yeah. Those birds were beautiful.
Oh, absolutely gorgeous. So it was such a treat. Justice was also, hi, Justice, good morning. He was there doing due diligence. So I'm so blessed to have an incredible team. We all brought it. So that is, we got a lot done.
Sweet. Yes, we'll definitely want to hear about that too. So if everyone, I'm sure you've seen the flyers and heard from Michelle, but we're going to talk about kind of what we've seen in the multifamily space as far as like markets. Let's talk about market cycles. Let's talk about even like wins. We talk about wins, and we're a very optimistic group and we're a very growth mindset group, but with that comes, like, we don't think about failure as failure, we think of them as learning opportunities. So we still have those same principles here in this group, and we want to just make sure that whatever like we may have experienced, like, you know, hearing from Michelle and all her experiences, she's very seasoned operator, like, what have you seen and what can we learn from those? So super excited to learn from any challenges. If you guys have any questions, feel free to put them in the chat. Is that okay, Michelle? And then we'll
100%.
Or do you want them to unmute themselves and ask anytime?
Well, look, this is a year in review, as well as we're at a tipping point. We're at a wonderful tipping point where we can look back and assess what happened, what went right, what went wrong, and then we can kind of forecast or predict in the future. Anyone who knows me knows I like prepping, so I have lots of different materials to kind of pull from. So if you want me to present, kind of like, the economics, overall economics, I'll even talk politics for just a brief moment. As well as the impact on multifamily and kind of my predictions, my fire crystal ball in the future. This is your time to be asking me. So this is an amazing sweet spot you're at. You know, it's December. We're all kind of doing rushing around, etc. But this is a great time to take a pause, look at the past, and see what we can change for a change of strategy in the next 12 months.
Perfect. Or hold on, you're gonna put your shirt on, right?
Yeah, I'm
Okay.
going upstairs.
Okay.
I'm grabbing hoodie too.
My son's gonna go for a run. We live in Florida, but sometimes, like, I see people running with no shirt on. I'm like, dude, please put a shirt on. So great. I love that, Michelle. You guys heard it straight from her mouth. Feel free to jump in and ask questions. Do you want to share the screen?
Absolutely, if you don't
We
mind.
have a question already? Or where'd you go? David?
Oh, I'm still here. I was just going to say, if nobody has a question, I've got one that I'll kick it off with. But if she's got content to share, let's look at it.
Absolutely. Or we could do both. Let's see. It's gonna be okay. So I'm going to share. Give me a moment. So some of you might have received my my email newsletter. I like to this last piece is just for those who are old school, might be familiar with the Clash. Um, I I'm a little cheesy, but the question a lot of people are asking themselves is, should I stay or should I go? Right? And should I keep investing, or should I just take a pause and go to the sideline, etc.? And so my question, I did this gathering with Neil Balwa. We presented about a month ago. You know, has commercial real estate hit rock bottom? Should I stay in the sidelines? Should I wait until I hit rock bottom and then jump in? There's been a lot of dry powder that's been taken up by, you know, the stock market right now, cryptocurrency, etc. So there's been some challenge in terms of raising capital for deals, etc. So my presentation is about where we stand and where we can go from there. And should I stay or should I go? So how's the economy doing? Some of you might have already seen some of these slides, but so I'll go through. But overall, the economy, and I was just listening, I'm an economist by training. I got my grad school degree at Johns Hopkins in international economics. I love econ. I mean, that's a passion. I do it for fun. I was just listening to The Economist this morning in a podcast, and they were talking about how, compared to the G7, in a bucket, if you look at a pie and you put all of the G7 countries, the wealthiest, most developed nations in the world, the US is over 50%. Well, historically it was 40%. The US economic engine now comprises over 50% of the economic pie, which is incredible. We are like the darlings of the world. Everyone's jealous of us. You know, we've been able to tame the inflation monster within a very short period of time, thanks to the Fed Reserve, thanks to our independent practices with the Fed. It hurt our pockets, you know, it hurt my pocket. But within a short span of time, roughly less than 2 years, the US was able to tame the monster of inflation. So this is all a good sign. Can everyone see this, by the way? Raise your hands. I just want to make sure. Okay, cool.
Yep.
In addition, we see job growth slowing. You know, it's been increasing. It's been a little bit sporadic lately, but overall, the overall trend in the last 16 months has been declining. So now the Fed is kind of switching its focus from inflation from the last 2 years over to job growth and job preservation. So that's been a little bit more the focus in the last 3 months. We see things slowing down. So we look at the PMI, which is the manufacturing index, and we see slower demand for for supply for materials, construction goods, steel, things of that nature. So we see this overall decrease, which means that prices are not going to go rocket high, but we'll talk about the possibility of that might be happening in the horizon. But overall, the PMI, we've dealt with and we've addressed the COVID bottlenecks. You know, how many of us have had problems finding materials and supplies and outrageous prices that we're paying right around COVID and post-COVID? You know, I was certainly one. Now, how many of us as operators were struggling to find HVAC systems and appliances and other things? I was another person. Now they've figured out, the manufacturers have figured out their supply, their inventory, and overall that bottleneck has been luckily addressed to our benefit. On the flip side, you know, on the consumer, we have huge debt. Americans love their debt. And that is putting pressure. We're at historical high. That is going to be putting pressure on consumer demand in the future, because people are going to have to start tightening their belts somehow, some way. And that is going to have a long-term impact on purchasing decisions. So with that lower manufacturing demand plus increased consumer good consumption and debt, pretty much leads the trend towards lower demand overall. What are the real economic signs? It's also complex. It's a mixed bag, to be honest. We have, I just came back last night, as Adam and Justice know. I arrived late last night from a business trip. You know, it is still increasing. Consumer confidence, especially post-Trump, has increased. It had been steadily rising the last year, and it has had a bump post-election. Car sales has increased. So these are signs of resilience, but also a mixed bag that kind of throws a wrench into the credit card debt. Maybe they're doing their travels and other purchases with their debt. The biggest thing that I look at as an economist is the SAM roll. That has been the largest and most predictable predictor of recession. And as you can see, I just updated the numbers last night. November numbers is around 0.43. So right under the 0.5 threshold. Above 0.5 has always signaled a recession. So we're still not out of the woods yet, is what I'm just saying. We've been working our way slowly up. And that's one of the reasons why we've exceeded it a couple months ago, about 6 months ago. So that was a signal that the Fed had to start tightening still, and still need to be active and monitoring inflation. But we're right below, and we're still trending. I noticed in October, November, it stayed neutral. It stayed the same. So this is all good sign that we might have a soft-ish landing, but we still have to monitor closely. The labor markets, we have lower inflation, low unemployment. It's only hovered around pretty flat between 4.1 and 4.2 in the last couple of months. So all of that is good sign. We also have strong wage growth. You've heard on the news, unions have been successful in negotiating stronger wages, and we still have a very, very strong and healthy job growth market. But what is the outlook? The outlook is a slower GDP growth, to be honest with you, especially in the next year. So while we might be the darlings of the G7 of the world, we should be experiencing, most economists do predict a lower GDP growth and a dip in 2025. We've had cuts. We had a 0.5 cut right before the election, and there is a prediction that we'll have a 0.25 point cut in the December 17th meeting of the Fed. So that will total a 50 basis point cut. But what's to come and what's most people are trying to figure out? Well, there's been a lot of signals by the Fed and by Powell. Before the election, there was talk about a whole 1% basis point cut. Now they've kind of dialed that back due to healthier job growth. So Powell and the Fed has announced that they're going to take their time. And I think that that was actually talked about the other day. So where does that bring us here to real estate? And in terms of real estate, we're still hitting that maturity wall. How many of you guys have heard of the maturity wall? A lot of stressed assets running into maturity, et cetera. Well, this is no joke. The multifamily market, I'm sorry, the CRE overall in 2024, loans matured. 1 trillion of loans have reached maturity in 2024 alone, and 42% of that was in multifamily alone. That's incredible. There is in the past couple of years, we've hit, there's been a cycle of extend and pretend. And now with the lowering of rates, there is still a lot of that is stopping, and reality is starting to bite. So that being said, there is still, by historical standards, we're still not in a massive alarm bell ringing percentage of defaults. It's predicted to happen and definitely to increase in the next year, but from an historical standard, from a historical perspective, it's still lower than in the past, and definitely a lot lower than the 80s. Cap rates. How many of us tried to sell? How many of us tried to buy in the last year? Cap rates have been kind of all over the board, and it's really also based on local markets. This is kind of a snapshot of Class A, but for all of us value add folks that are looking at Class B and C, you could bump that up to by another percentage, 100 points. So multifamily is looking at a 5.5 to a 7.5 on a rough scale. And again, it's really based on the local markets. But that's definitely what we're seeing in markets like Texas and Kentucky, Louisiana, et cetera. So I know I'm only going to gloss over this a little bit because I don't want to get too political. And wherever you land on the color skew between red and blue, the Trump White House is going to have a real impact on real estate. Okay. And I'm going to show a balanced approach. So fair warning. So here's some of the pros and cons. On the pro side, there's definitely been a lot of talk about greater deregulation. He's talked about opening up some of the Fed lands to help with supply, help with developers, and getting rid of the red tape. The issue right now, and that's the debate, is which federal land and how close to infrastructure, right? Because if you open up these federal lands and they'd have no infrastructure, you're not going to be able to, you're not going to get anyone to build anywhere if there are no roads to get to. So if for whatever reason they're able to change that and open up regulation, start some deregulation closer to higher concentrated areas, then we can see supply in the long run increase. And with there's been talk where over about 3.5 to 7 million, we're 3.5 to 7 million houses short. There's crazy number, like everyone's tried and their mother has tried to buy, and the average price is a 417,000, which is a 23% increase since COVID alone. Insane. So that will directly have a positive impact on on housing prices and greater supply. On the flip side, you have a lot of talk about global tariff war. You know, between Mexico, between Canada, they've already responded saying that they were going to retaliate. China is a big target. They've already signaled that they would retaliate. And so for those history buffs out there, there's been a lot of talk about discussion of the impact of Smoot-Hawley during the 1920s, right leading to the Great Depression. And I love history, and that had a devastating consequence in the Hoover administration, the Smoot-Hawley Act, on the U.S. economy. I don't think it's going to get to arrive to that situation, but right now the U.S. and the rest of the world are more interlinked than ever before. So the impact of a global tariff threat is even more menacing. And that is going to have unfortunately, the reverse impact of what I talked about in the first slide, untaming the inflation monster. It's going to rear its ugly head again. Another con is the threat of mass deportation. While that might be great from a media perspective, unfortunately for us in real estate, that has a direct impact on construction costs. The nationwide percent of undocumented workers in construction alone is 13%, but that is actually 20 to 25% in the Sun Belt or bordering states such as California, Arizona, Texas. All those bordering states are going to have reap the consequences of labor cost increase. So that unfortunately is going to hit our pocketbooks if that happens. And that's a threat too. On the pro side, we all love 100% cost seg bonus depreciation, right? So that was something that in Congress was held, it was supported, was a bipartisan support. It was held up last year. And after talking to a few cost seg experts in the past week, they feel very strongly that the new administration, this will pass. So yay for us. So this is just kind of a balanced approach. Again, I'm not saying one or the other, but I'm just saying how it's going to impact real estate and our pocketbooks directly. I'm guessing we can ask questions later. So how does this impact multifamily? So we have economics is pure supply and demand, really. So prices, we have a crisis of housing in terms of the affordability and the supply right now. We talked about this. Right now, we talked about the 416,700 is the average price of a home right now. That's ridiculous. Ridiculous. People cannot afford their homes. In addition, I don't know about you, but I'm locked in. You know, how many of us were fortunate to do a refi at a very low interest rate? So, you know, we have a locked-in effect where boomers can't afford to move. And it was just talked about in the Wall Street Journal today. They cannot afford to move. So you have a decrease, increases of prices, a decrease of inventory. That's only going to cause that crisis. Across the country, you have to make 115,000, whereas the average household income is less than 50. I mean, that speaks for itself. I'm going to kind of flip these around here. However, in multifamily, there's been a lot of talk that rents have gone sky high. We've heard these complaints. There's been lots of articles written about it. But when push comes to shove, here's the truth. Wage growth and rent growth has pretty much grown 1 for 1. on the right. Whereas owning a home has skyrocketed and is more than doubled in terms of affordability. So we're seeing, and I predict that there's going to be just a greater pie of renters versus home ownership from not just next year, but the large trend across the country is going to be greater, less home ownership unless something significant is done, and more renters, which is great for us. We also see a slowdown in terms of construction starts. Supply has peaked this year. That's why in certain markets like Austin, Dallas, Houston, certain parts in Florida have actually experienced rent growth, a negative rent growth, because those introductions of new Class A supply. However, we predict this is going to go down dramatically, unless, of course, the new administration does something very enticing to bring them back in. The rent growth outlook, we've all been kind of hurt by the last 2 years. It's been pretty flat or negative, right? It's changed a lot of our underwriting forecasts and made them, we've had to recalibrate accordingly. However, the good news, I like on a Saturday morning, since you are all up early, the good news is Yardi just updated their forecast just recently in November. It's been steadily growing, and we are also seeing that trend. So with less supply coming in terms of apartment supply, we're definitely seeing a correction and a positive outlook for rents in the new year. So again, this is market specific, because certain markets, especially Austin, is not out of the woods yet. So should I stay or should I go? Right? I truly believe, and my team truly believes, that it's an amazing time. From a macroeconomic scale, we have tamed currently the inflation monster or bear. We know that the rates are falling. Maybe in 2025, it might not be 4 cuts. It might be 2 or 3 smaller cuts, but the projection is the movement is towards that direction. We also know, and we've experienced, a recalibration of some prices, much better cap rates in terms of the market. There are amazing stressed properties out there for the pickings. So we see some correctly discounted deals go through. The economy is super strong. However the media puts it, across all metrics, the economic engine in the US is booming. I talked about the rent versus buy. There's going to be more renters. We are seeing more favorable loans because thanks to lower rates. And people are looking for are needing housing, are needing shelter, and the only way is through providing safe, clean, affordable apartments for our workforce, for the value add, for our Class A and B residents. So that is pretty much, again, should I stay or should I go? My bet is stay and reap the rewards. And that's why you're here. So with that said, I appreciate your time and allowing me to go through this. I will, for those who if Kimberly, could you and Winston, could you kindly get people's emails? And what I'll do as a gift for all of you guys, since you're all up, and this is exclusive for you guys, you will get my internal database of economic metrics for free. I do a lot of the Neil Bawa, like crystal ball, plus I put it on steroids. I track job growth, I track climate risk, I track legal laws across the different states and cities, and I also track the rent growth. So if you're interested, it just covers the top 300 cities in the country, but you can get it. It's an AI tool that I've developed. It'll do the analytics for you. So
Yeah.
with that being said, I appreciate it. I'll stop my presentation.
Well,
No,
thank
we
Yeah.
appreciate that. That's tremendous. And again, thank you for the little plug in the end. If everyone wants to go ahead, I know we can track it, but throw your email in the chat, especially for others that are saving the group chat. It'll be helpful. But no, Michelle, thank you so much. Obviously, your expertise is highly valued and regarded, and the fact that you're willing to provide some other tools that help us with market research, we're immensely grateful. So thank you.
My pleasure. Yeah, this was in collaboration. This information was in collaboration with Neil. So it was a presented about a month ago.
Yeah, we seen that. Our team here was like, "Oh, did you guys see Michelle now?" So we were excited. I know it's like in-person event, but we definitely seen your advertisement. We're like, "Oh, how do we get that information?" And it's like, "Well, let's
There
ask."
you go. You got it.
Yeah, thank you so much. I do see tons of questions in the chat. If
Oh,
anyone wants to come off mute and ask first, we'll do that. So just go ahead and raise your hand, or we'll call on you, and then we can hit the chat after. So Tyler, I seen you put a couple in there. So go ahead. Go ahead.
Yeah, I'll do one at a time and we'll just go down the list here. So the first question I had, Michelle, for your teams, when you guys are submitting LOIs to potential sellers, what are you guys noticing to be consistent regardless of market? Like I gave a few examples, like X below asking price, sellers having bridge debt that they're trying to get out of, failing partnerships. Like those are just some examples, but I'm curious what trends you have seen so far and what you think is going to continue.
yeah. So 2023 started the trend of stressed assets. It's a great question. I was able to pick up one, but there's a lot of sweat equity. There's a lot of sweating in that equity when you're buying a stressed asset. We definitely saw an increase of, can I swear here? I'm so sorry.
Yeah, of course.
You can with
Of
me.
course.
You know me, Michelle. You're fine.
Grown. Kids are out. Kids are out.
I mean, let's put it this way, 2023 and 2024 for operators was kind of a shitstorm. Okay, so so to answer your question, Tyler, you saw for current operators, if they were on bridge debt, you saw, and they weren't capped, you're kind of screwed because you were paying through the nose in terms of in terms of interest rates. Plus, the double whammy of can I say the word insurance? I mean, insurance was ridiculous. I mean, how many of us saw at least a 30% rise in insurance, right? And in some parts it doubled. So it's no joke. So that had a huge negative impact on your NOI and those valuations. And yet we as operators were still thinking that the valuations were this high, when in reality, and the market was demanding something like this. So there was a lot of people were sweating bullets. A lot of distributions didn't happen. A lot of infighting happened in partnerships and partnership divorces. So you're right to say all of the above, Tyler, happened, I guess to say. And yeah, so you saw increased operating expenses plus rent growth going flat. So you couldn't increase that. There was pressure. You had to provide greater concessions. There were greater vacancies. And so you had lower revenue, higher expenses, lower NOI, lower valuation. It hasn't been fun for a lot of operators.
No, I'll just share something overall for the rest of the group here because Winston and I have been shopping North Carolina, South Carolina, as you know, and I don't know what's up with these sellers, but they're asking for absurd prices, and people are giving them their offers, which I find ridiculous. but we're consistently coming like 30% under. And so that to me is kind of like, okay, I don't know what gives first. Are the sellers actually going to reduce their prices, or are people just going to continue to overbuy and screw themselves on their returns? Right? Because that's what I'm seeing happen in North Carolina a lot.
Yeah, so as a sponsor, I will say that the quick analysis is if it's within a 20% fudge room of the whisper price, it's worth submitting. And then if it's beyond that, you just need to get on the phone and say, how long has it been on the market? Should we even bother, going through underwriting and submitting a bid? But I would say that I would submit the bid anyway if it's within 30% and just expect a very low burn and just kind of monitor and see, kind of pop in every once in a while, every few weeks and say, has it moved? Has the owner sobered up yet?
That's a good way to put it. We need to adapt that vocabulary, Winston. Yeah,
There
I
you
got
go.
more, but I'll let other people go. Thank you, Michelle.
Yeah, no problem. Do you want to choose who speaks next?
David, I see
David,
next in line.
next in line.
Hey, let's do it. Good morning, everybody. Good morning, Michelle. Thanks for being here. Sorry about your
morning, David.
tornado warning. That's crazy. Especially for that part of the country. So you mentioned that, kind of coming into 23, 24, a lot of, operators were having to shift underwriting models a lot, somewhat unexpectedly, because everything was going crazy, interest rates and inflation and the like. And of course, that was all happening just as I was, with Rachel, we're getting involved in multifamily, right? So we came in right at the beginning of that shift. So, what are you seeing that's going to happen, and how do we need to shift our underwriting models moving into 2025 and 2026? And, one of the tensions I see, right, is you've got tariffs on one hand, which is going to drive inflation, and you've got things like 100% cost segregation coming back, which is going to help investors, right? And so you've got this tension of, are we going to net zero and we still need to be really cautious, or can we start relying on some of that optimism?
That's an excellent question. And actually, I have a couple of people on the call that can probably speak just as much as I can in terms of underwriting. I would say that you have to calibrate. You have to create those WTF reserves. So when I underwrite, and some people can attest here, is that we have a 12-month insurance reserve because we can't predict the insurance right now. I have a much higher annual growth rate or annual expense growth rate on insurance than my other categories. I've spoken to other sponsors in which, if you are on the coast and in a high climate risk area, I do a 5% by standard as opposed to others 3%. But if you're closer to the coast, it should be a growth rate, expense growth rate of 10 to 12%. And that sounds a lot. That's going to kill a lot of deals. But what I also do is ask and demand in my underwriting a 12-month reserve for insurance alone that does two things. It helps with those huge spikes, unexpected extra spikes in terms of insurance premiums, but also it serves as a leverage on the flip side to negotiate better rates with your insurance provider, because you have more as a reserve to pay for the deductible. Other things that I do, other reserves, I actually have extra months than the average. People have talked about 2 months in operating expense. I do it 4. I double that. Contingency reserves and CapEx plus an extra, emergency reserve and CapEx. So I double the CapEx in terms of, WTFs. And then my team was just out there, and this is a big lesson I've learned. And so do what I say, not what I've experienced. I've definitely had some great lessons learned here. A big failure is our CapEx. A big failure in a lot of sponsors is they kind of lean too heavily on property management teams to go in and do the inspections for them. And now I will never do that. Now we visit every single unit. We open up every single appliance, flush toilets, turn on faucets. We look under the faucets. I'm there with them. We're checking smoke detectors. We're looking at age of the HVAC, the age of the water heaters, and we tally it all up. Which is probably one of my homeworks today. From yesterday, last couple of days, and that is your fuel for fire, you guys. Do not underestimate the power of this physical due diligence, because it's going to give you a very clear understanding of what CapEx is needed to execute on your business plan, and also on the flip side, on the very positive side, to retrade, because you have something that's extremely documented.
Taking that question a little bit further, Michelle, what do you guys do when you're in California, you're purchasing in Texas? So the first initial due diligence, you're there, wonderful. But what about monthly or quarterly? Are you visiting the property consistently? Like, if everyone's spread out, if you don't have boots on the ground, or do you have boots on the ground
We have boots on the ground.
in that particular market? In that,
Yeah, we would need to have boots on the ground, because
Okay.
You asked me to talk a little about fails.
yeah.
I've got tons of them. So
Yeah, we can learn a lot from those. I hope everyone is. I
Yeah.
don't want to be selfish, but yes, like I love to hear it. Not to say, oh, Michelle, like you failed on that, but these learning lessons, absolutely. My mom, I was raised like that. Like you learn
Yeah.
from mistakes, and so that's
Yeah, the biggest one of the biggest fails, and I'll be honest, was relying too heavily on the property management inspection team to do the physical due diligence. They'll say they'll do it. Oh, great. And then you just kind of walk around with them. But they're in and out within a couple of seconds. And what was it? We just developed this ClickUp app. It's still crude testing on the Summers. I do not take credit for that, but the Brandy and Jessica Summers helped create this. We're fine tuning it. We were the pilot study, and we're basically going through every single room, checking the walls, checking the ceiling, checking the fans, checking the lighting. We're counting the screens. We're looking at the quality of the windows, etc. The more it is better, you guys, to spend another 2 days on site going through every single unit, double checking your work, etc., than having to look like you have egg on your face in front of your investors and say, we didn't budget enough in CapEx, and now we can't give a distribution. So that is,
How much hand holding do you guys have with your property management? Because I think we kind of relied on our property management too much. So do you guys help them get bids, or do you ask them, hey, we need a new parking lot, like getting bids? Are you guys reaching out yourselves, or roofs, or plumbing? Because sometimes I feel like they're in this business. They are a business. Property management is a business. Are they giving just their best friend some business, and their best friend is charging this exorbitant amount, or are we actually getting? I think those are some of the questions that I've came across now. Is like, does it really cost this much?
Ours is trust but verify.
Yes.
So that's kind of I know Justice has heard the don't trust, double verify quote. And I definitely do that. I've done that a lot. If it smells funny, if your gut, look, you guys are all smart cookies. Go with your gut. If something doesn't sound right, then triple check that information. Right? If something's too good, like yesterday, I got this crazy bid for insurance. It was before 208,000, and I got this quote for 76,000. Yeah, right. And I'm like, that's I want to believe it's true, you know, that's gonna help me, but I I can't lie to myself. I'm like, something sounds wrong. Something feels wrong. So I'm 90% practical. Yes, you're right. Um, so yeah, it's unfortunate. I asked, it was a year quote, so year premium. I'm like, what the heck? So that's why I was, again, you have to double check people's work. And on all major expenses like roofs, we get 3 quotes, and we do it ourselves. We have an asset management team on my deals, and we that's part of the homework.
I like it. I like it. Doing it. Okay. Yeah. I don't want to take all the questions. Amanda?
Hi, Amanda.
Hi, Michelle. Thank you so much. This is super enlightening. I'm a data geek and also love history. So this was really helpful for me. Thank you. Question on the macro side of the job growth.
Yeah.
I've always wondered how the Fed calculates that job growth number and like what factors into it, because during COVID we saw the job growth numbers. I always wondered how real they were when you had so many people literally leaving the workforce that I don't think were a part of that. And then now we have a whole trend that seems like it's going towards more of a gig economy, 1099. Companies are outsourcing, they're not hiring on W-2s. So how real is that job growth number, and what's the danger of that recession if the numbers are padded?
So that's an excellent question. In a lot of cases, the initial number is just a prediction, and then they do an actual. So there's always a double check of the work, and this comes from the Bureau of U.S. Bureau of Labor Statistics. Those charts that I showed were non-farm payrolls. So just to kind of just to be more accurate, it's just so manufacturing, tech, etc. They count jobs. They don't count what type of jobs. So as you said, the gig economy evolution is going to have a direct impact on people's ability to affordability metrics, right? So you're absolutely right in terms of yes, they might count as a job, but what kind of job? How stable is that job? How protected is that job?
Okay.
Yeah, you can't track that, unfortunately.
Okay, but that only leads more to people renting rather than buying, affordability. So that's in our favor. So that's, I guess, a good thing.
Yeah,
And
absolutely.
my other question too really had more to do with asset classes. We saw, post COVID, we saw a lot of operators who formerly had been on the multifamily value add train move into more core plus A neighborhoods. We saw that trend to reduce risk, I'm assuming. And I guess now I'm wondering, um, what are your thoughts on, is that does that have merit? Is the value add still the place, the premier place to be? There's build to rent, there's mobile homes, affordable housing. There's some other asset classes that
Yeah.
I'm also seeing opportunities in. I'm just wondering what your thoughts are on that.
I mean, look, I'm all about the numbers at the end of the day. So whether it is a build to rent or whether it is mobile parks, a lot of people are seeing this. I'm still seeing, what folks might have heard of Bob Bowman. He's really been full on in terms of the RV parks, etc. And totally respect that. I get he's seen a lot of. He and I talked a couple weeks ago in Tennessee, and he's seen really great returns. And that's totally fine. I'm still seeing those same returns in the value add space.
Awesome.
You know, I'm without revealing too much. I mean, this deal that I came from, our total returns are are in the low 30s.
Nice.
So I'm greedy with my numbers. Everyone has heard me saying I'm greedy with my numbers. I do not want to do a deal because there's so much, you guys, there's so much fudge room and the WTFs in life. You know, we all know we have this path and, you know, we've all gotten diverted. We've all had to shift and pivot in our careers, in our lives, etc. And that pertains to multifamily. You have to be flexible and be ready to pivot. I'd like to have a little bit of buffer in my returns so that they're still getting a kick-ass return at the end of the day. It might not be 24%, it might be 22, but it's certainly tons better. And they also get the bonus cost segregation. They get the tax, they reap the rewards, which I'm sorry, but the stock market and cryptocurrency don't.
Yeah.
You're actually paying AMT taxes. You're actually exposed in the US for more taxation in cryptocurrency. And if you anyone who's come from tech, which is me, we've had to pay AMT, unrealized gains. I don't have the money in my wallet to pay unrealized gains for some stock option, and it's real estate has still outperformed the market time and time again in the long run. And you've got and this economy and our administration has been built to be very, very favorable to real estate, to landowners.
Awesome. Thank you. Well, I'm a believer that focused effort gets results. So if we can
Yes.
do the same thing in multifamily and there's no real driver to, you know, muddy the waters, I think that's certainly better. So thank you.
Yes, you're welcome. Thank you. Any other questions?
I seen Jessica had a question in the chat. Do you want to come off mute and ask? Jessica Perez.